Through the issue of shares and debentures to the public, you are creating financial assets. This allocative functions can be performed by the banks and it can also be performed by the financial markets. A financial market is a market where we create financial assets and also exchange financial assets. Hello everyone, I am Purnima, faculty in the Department of Commerce, Vidhyaashram Pre-University College, Temple of Excellence. In this session, I will be discussing about the next chapter, that is financial markets. Now, what do we mean by financial markets and what are the types of financial markets and what are the various types of instruments which will be traded in the financial market? All this we will be learning in this session. Now, why do we need a financial market? So, whenever we have to start a business, we need two types of funds. One is the long-term fund and other one is the short-term fund. Now, this long-term funds we need for purchase of fixed assets or what we call as the fixed capital, whereas the short-term funds, they are utilized for the day-to-day working of the business organization. So, there are two types of funds which are needed by the business, and as such, the business will have to raise all these funds through the financial market, or in other words, we can say that financial markets are the intermediaries through which the various businessmen, they will be raising the funds for their business activities. So, whatever funds are saved, they will be utilized by these businessmen. Now, let us look into what is the content of this chapter. Now, in this session 1, or in this chapter on financial market, so we will be having a brief discussion on what is a financial market. So, we all are familiar with the word market. So, market is a place where buyers and sellers meet and transact business, or there is an exchange of goods and services for money. Now, what do we mean by financial market? Now, financial market means it is a market where the businessmen will be able to raise the finance for their business needs. So, financial market is a place where you can source your funds for the business. Now, next we will be looking into what is the money market, and we will also be able to describe its major instruments. Now, we know what is financial market, and then we will be discussing about the types of financial market. The first type is the money market, and what are the various instruments which will be traded in the money market. And next, we will be also discussing about the nature and types of capital market. Now, we should understand that through the capital market, all the businesses will be able to raise the capital, that is the long-term funds needed for the business. Now, the next, we will be having a comparison between the money market and the capital market, and then later on, we will also be having a brief discussion on what is a stock exchange, the meaning and functions of stock exchange. Now, what is the meaning of a stock exchange and what are the various activities which will be carried on by the stock exchange? This we will be having a discussion, and then next we will be just discussing about the functioning of NSCI and OTCEI, and also the role of SEBI in investor protection. So, how powerful SEBI is or how it is educating the investors. So, all these things we will be studying in this chapter. Now, first let us look into the meaning of the word financial market. Now, financial market is a market where businessmen are able to raise the sources of finance. Now, it may be the long-term source or the short-term source. It is all raised through the financial market, or it is a market where the businessman can go and shop for the finance. So, here shopping for finance means you are able to source your funds in the cheapest possible way and in the best possible terms. Now, let us look into how the financial market will work and also the meaning of the word financial market. Now, here we have these household savers and we have the business firms and the investors. Now, the householders. So usually there will be lot of householders, people who will be saving the money. Now, where do we usually save our money? It is always saved in banks. So even the savers also, we will always be saving our money in the SB account of the bank. Now, the business firms and the investors, they will be contacting the banks and financial markets for their business or the financial needs. Now, here we should understand that these banks and financial markets, they are the financial intermediaries. So, they are the financial intermediaries. That is, they collect money from the householders and savers and they will be lending to these business firms and investors. In other words, there is mobilization of savings on one side and also granting of loans to the business community on the other. So, in this way, the banks are able to see that they are putting the money into proper and productive use. Now, whatever the interest they will be giving for this savers or the householders, that will be very little interest. So, a small percentage of interest will be given to the householders and savers, whereas they will be lending to the business firms at a very high rate. Now, the difference between the interest rate which they will be paying and the which they will be lending, so that difference amount will be the profit to the banks. Now, let us look into what is the meaning of the word financial market. So, a financial market helps to link the savers and the investors by mobilizing funds between them. Now, a financial market, it is helping us to link the savers and the investors by mobilizing funds between them. So, on one side, it is collecting all the funds saved by the householders and on other side, it will be lending the very same funds to the businessmen. In doing so, it performs what is known as allocative function. Now, what is this allocative function? So, in this allocative function, the banks will be lending to those sectors which are considered as the priority sector or those sectors in which the productivity is very high, so that they can get a very good return on their investment. So, it allocates or directs funds available for investment into most productive investment opportunity. So, whatever funds it collects from the householders and the individual savers, it will be lending to the business community who will be putting it to the most productive use. So, this is the allocative function performed by the banks. Now, next, let us see what will happen when this allocative function is performed. So, when allocative function is performed well, the rate of return offered to household will be higher and scarce resources are allocated to those firms which have the highest productivity for the economy. So, first one and the second one. So, whenever the banks are given this opportunity to just invest in the business community, it will be an opportunity for them to just get a higher rate of return on their investment. And second allocative function is these scarce resources can be put to the best possible use. So, this allocative functions can be performed by the banks and it can also be performed by the financial markets. Now, if it is performed through the banks, it will be in the form of savings which will be deposited in the bank and then it will be dispersed as loan to the business community. But if it is allocated through the financial market, the individual savers and the householders, whatever money they are saving, they will be purchasing in the form of equity shares, preference shares and debentures. So, in this way, they will be allocating the money, or they will be directly investing in the capital market. So we can understand that this allocative function can be performed through banks, and it can also be performed through the financial markets. Now, the next one, a financial market is a market for creation and exchange of financial assets. Now, we should understand what is the meaning of the word financial market. So, financial market is a market for creation and exchange of financial assets. Now, what are these financial assets? Let us look into. So, financial markets exist wherever a financial transaction occurs. So, financial transactions could be in the form of creation of financial assets, such as initial issue of shares and debentures by a firm, or the purchase and sale of existing financial assets like equity, shares, debentures and bonds. So, a financial market, so we should understand that it is a market for creation and exchange of financial assets. Now, we should understand what is the meaning of the word creation of financial assets. Now, creation of financial assets means you are issuing shares and debentures to the public. Now, through the issue of shares and debentures to the public, you are creating financial assets. Now, this creation of financial assets is done through the financial market. Now, we should also understand that a financial market will exist wherever there is a financial transaction taking place. Now, the next aspect of the financial market is there will be exchange of financial assets. Now, we have to understand the meaning of the word exchange of financial assets. Here, exchange of financial assets means sale of existing financial assets like equity, shares, debentures and bonds. So, a financial market is a market where we create financial assets and also exchange financial assets. Now, creation of financial assets is done through issue of shares, bonds and debentures, and exchange of financial assets is done through the sale of financial assets. So, we should understand that the financial market is a place where there is a dealing in financial assets, or it is a market where all the securities can be purchased and sold as per the forces of demand and supply. And we should also understand that it is through the financial market only the prices of shares and debentures will be formed, or we can decide about the prices of shares and debentures in the financial market where the forces of demand and supply will be applied. Now, let us look into what are the various functions of the financial market. Now, the first function of financial market is mobilization of savings and channeling them into the most productive uses. Now, what do we mean by mobilization of savings? So, almost all the banks or almost all the individuals who are in the society, they will be having a bank account. So, it is through the bank account only almost all the transactions take place. Now, this bank account is created in order to see that people save as much as possible. So, whenever people save money, the money which is collected from the people will be lent to others who are in need of finance, or the money collected as savings will be lent as loans to the business community. Now, mobilization of savings, it gives savers the choice of different investments and thus helps to channelize surplus funds into most productive use. Now, if you are saving in the bank, you will be getting a fixed rate of interest. So, the bank will give at the most 3% or 4% at the most. So, it will not be able to give more than that. But with the help of this financial market, we can get a greater return on the savings. So we will be able to identify all those areas where we can get more and more returns on our investment. So this is possible with the help of financial markets. So with the help of financial markets, we will be able to mobilize the savings and channeling them into most productive uses. So here the investors or the householders or the individual savers, they can expect to get a greater return on their investment through this financial markets. Why? Because it is through the financial markets they will be able to purchase shares, debentures, bonds, etc., and which in turn will give them a greater rate of return on their investment. So this is the first function of financial management. Now, the next function of financial market is facilitating price discovery. Now, in the financial market, the households are suppliers of funds and business firms represent the demand. So, these are the suppliers and the business community has the demand. The interaction between them helps to establish a price for financial asset which is being traded in that particular market. Now, in the financial market, the suppliers of funds, who are the suppliers of funds? The individual investors and the household savers. So, they are the suppliers of fund in the financial market. And who is demanding the fund? The business community is demanding for these funds. Now, the suppliers are there and the demand forces are there. They both will be operating in the financial market. So, based on the forces of demand and supply, they will be able to establish a price for the financial asset which is being traded in that particular market. Now, in the financial market, when there is an excess of supply of shares in the market, it will result in a fall in the price of such shares, and there is a lot of demand for the prices of a particular company share. That company share will rise. So, in this way, the forces of demand and supply will act in the financial market, as a result of which the prices of the shares and debentures, etc., will be decided. Now, this facilitation of price will be done through the financial market. Now, the next function of financial market is providing liquidity to financial assets. Now, financial markets facilitates easy purchase and sale of financial assets. Now, the holders of assets can readily sell their financial assets through the mechanism of financial market. Now, first we should understand what is the meaning of the word liquidity. Now, the liquidity means how fast you are able to convert these investments into cash. Now, cash is called as the liquid asset because it is easily transferable from one person to another. Now, when we talk about liquidity of financial assets, it means that you are able to convert these shares and securities into cash as fast as possible. Now, who is facilitating this conversion of shares into cash? It is the financial market. Now, this financial market, they are a meeting place for the both sellers of shares and buyers of shares. Now, here most of the forces of demand and supply will be applying here, and as a result of which there will be price fixation of the shares and debentures. So, when the investor feels that his investment has reached a very high peak, then he can always sell off his shares and then he can get back his investment. Now, suppose he feels that he has more money and he can purchase some assets, then he will start purchasing such assets. So, this facilitation of buying and selling of the shares or securities, it is done with this financial markets. Then, The next function of the financial market is reducing the cost of transactions. Now, what do we mean by reducing the cost of transactions? Now, the financial markets provide valuable information about securities being traded in the market. It helps to save time, effort and money that both buyers and sellers of financial asset would have to otherwise spend to try and find each other. So, they provide valuable information about securities being traded in the market. It helps to save time, effort and money. Now, with the help of the financial market, we will be able to gather information about the various prices of the various securities which are being traded there. Now, if there was no financial market, then the investors would have to spend a lot of time in knowing what is the share prices, what is the price which is running there, etc. So, lot of effort and money would have been wasted in case there was no financial market. Now, this financial market, it is giving us timely information. So, to both the buyers and sellers. So, whoever wants to buy, they will give you the price of this share at this time is this much, and the price at which it is sold is this much. So, valuable information is being provided to all the investors, and which will help in saving their time, effort and money. And this is through the help of the financial markets. Now, the next, let us look into the classification of financial market. Now, financial markets are classified on the basis of maturity of financial instruments traded in them. Instruments with a maturity of less than 1 year are traded in the money market, and instruments with longer maturity are traded in the capital market. Now, if you can see here, they are the financial market is classified into money market and capital market. So, in the money market, the instruments have a maturity of less than 1 year, whereas here in the capital market, it is more than 1 year and it goes on up to 15 years also. You can have this money from the capital market. Then again, we should also understand that capital markets are again classified as the primary market and the secondary market. Now, in the primary market also, we have two types. The first one is the debt market and the equity market. Even in the security market, we have two types, that is, one is debt and the other one is equity. So, we have a classification of the financial markets. So, it is always based on the maturity of the instruments traded in them. So, for the short term funds, it is money market, that is short term funds, and capital market is for the long term funds. So, short term means it is for the period of less than 1 year, whereas for long term it is more than 1 year, up to 15 years, 20 years also you can get the funds from this capital market. Now, let us look into what is the meaning of the word money market. So, money market is the market for short-term funds which deals in monetary assets whose period of maturity is up to 1 year. So, as I had explained earlier, the financial markets are classified as money market and the capital market. Now, in the money market, we are seeing instruments which are being traded with a maturity of less than 1 year. So, if you have a demand for fund for just 1 year, then we can always go to the money market and raise the funds for a short period of 1 year. Then, it is a market where low risk, unsecured short-term debt instruments that are highly liquid are issued and actively traded every day. Now, in the short-term money market, we can find instruments which have very low risk. So, here the risk is very low and unsecured. So, they don't have any collateral for this money market, and short-term debt instruments. So, the short-term debt instruments means it can be anywhere between 15 days to 1 year, and that are highly liquid. So, highly liquid means they are easily converted into cash, are issued and actively traded every day. So, in the money market there is active participation, active trading every day, it will be going on. So, we should understand that a money market is a place where we can raise short-term funds, and it is through instruments which have very low risk, which are unsecured, and they are short-term debt instruments which are highly liquid, that is, which can be converted into cash very easily, and they are issued every day and they are actively traded every day. Then, next, let us see what this tells us. So, it enables the raising of short-term funds for meeting the temporary shortages of cash and obligations and the temporary deployment of excess funds for earning returns. Now, through the money market, we will be able to raise short-term funds for meeting the temporary shortages of cash. So, temporary shortages of cash means if there is a need for working capital in an organization, then they can always raise the funds through this short-term funds, and the temporary deployment of excess funds for earning returns. So, if they have any excess funds, they can always use it for earning the returns. Now, the major participants of the money market are the Reserve Bank of India, commercial banks, non-banking finance corporations, state governments, large corporate houses and mutual funds. Now, we know that money market is a market for short-term funds. Now, who are the major participants? Can we all go and trade in the money market? No, we cannot trade. Individual investors cannot trade in the money market. But then, who are the participants in the money market? So, we should understand that the major participants are the Reserve Bank of India. We also call it as the RBI. Then the commercial banks. So, commercial banks is those banks where we just put in our deposits or from whom we can avail the loan facilities. They are called as the commercial banks. And then non-banking finance companies, that is NBFCs. So, these companies, they just engage in providing finance, but they don't do any banking facilities. Then state governments. So, they will be one of the major players in the money market, and large corporate houses and mutual funds. So, mutual funds are collected from the people as SIPs and they will be invested through the money market. Now, we should understand that money market is a market for raising short-term funds of the business. Second one is the instruments of the money market are highly liquid and they are considered as the substitute for cash. And also, we should understand that this money market does not have any location. There is no physical location as such for the money market, and almost all the transactions or activities relating to the money market, it will be through the phone and internet. So, we should understand that money market does not have any physical existence, or there is no physical location for money market, but then it has a existence in the telephone and the internet. Now, let us look into what are the various types of money market instruments. Now, the first type of money market instrument is the Treasury Bill. A Treasury Bill is basically an instrument of short-term borrowing by the government of India maturing in less than 1 year. So, it is an instrument of short-term borrowing by the government of India which matures in less than 1 year. They are also known as the zero coupon bonds issued by the Reserve Bank of India on behalf of the central government to meet its short-term requirement of funds. They are issued in the form of promissory note and they are highly liquid and have assured yield and negligible risk of default. Now, we should understand that treasury bills are issued by the central government of India, and on behalf of the central government, the Reserve Bank of India will issue the treasury bill for a period of less than 1 year. They are also known as the zero coupon bonds, and they are issued in the form of promissory notes. So, promissory note is, it will be issued in the form of a promissory note. That is, the government will say, I promise to pay you this amount of money on this date, after this year, on this year, etc. And it is highly liquid and have assured yield and negligible risk of default, because there will be no default and it is the government which has been promising the investor the money. So, the government will keep up its promise. Now, let us take the example. Suppose an investor, he buys a treasury bill of rupees 50,000 for a period of 90 days. Now, on this day, suppose he purchases a treasury bill for 90 days and the face value of the bill is 50,000. So, this is the face value of the treasury bill. Now, this bill will mature after 90 days, that is March, April, May. So, in May it will be maturing. Now, he will be paying just 45,000 when he is purchasing this bill, and the difference amount, that is 5,000, he will be getting at the end of the 90th day. Now, the difference between what he is paying and what he is receiving on the maturity date, that will be the interest on this treasury bill, or what we call as the zero coupon bonds. So, in these treasury bills are issued at a price below the face value. So, if it is a treasury bill for 1 lakh, it may be issued at 90,000 or 96,000 or 95,000. So, at the end of the maturity date, they will return the full amount, whatever is on the face value of the bill. So, the difference amount between what is being paid and what is receiving, that will be the interest for which the person has invested. Now, these treasury bills are issued for a very short period of time, that is anywhere between 15 days to 1 year. Now, the next type of the money market instrument is the commercial paper. Now, let us understand what is the meaning of the word commercial paper. Commercial paper is a short-term unsecured promissory note, negotiable and transferable by endorsement and delivery with a fixed maturity period. Now, commercial papers are issued by large corporate houses or large companies which are very sound and which are in need of finance. So, they are issued in the form of unsecured promissory notes. The company will issue a promissory note which are negotiable and transferable. So, it is easily transferable from one person to another and delivery with a fixed maturity period. So, they will have a fixed maturity period and it is issued by large and credit-worthy companies to raise short-term funds at lower rate of interest than market rates. So, they are issued by large companies at lower rate of interest than the market rate. So, if the existing market rate, the funds are available at 7 to 8%, then these commercial papers will be issued by the companies at a reduced rate. They will be giving at 5 to 4%, etc. It usually has a maturity period of 15 days to 1 year. So, commercial papers are issued for a period of 15 days to 1 year. So, this is a very short term finance. Now, next, the issuance of commercial paper is an alternative to bank borrowing for large companies that are generally considered to be financially strong. It is sold at a discount and redeemed at par. Now, these commercial papers are issued by large corporate houses whenever they have to meet some major expenditure like purchase of a machinery. So, when they have to buy machinery, heavy investments, etc., they will have to raise lot of finance. Now, when they have to raise lot of finance, they will also have to bear the flotation cost of this issue of shares and debentures. Now, to meet this flotation cost, so this flotation cost will be for a very short period. So, to meet this expenditure on flotation cost, the banks or the large corporate houses, they will be issuing this commercial bills to see that they meet the expenses relating to flotation cost, as a result of which they can always issue shares and debentures and raise long-term funds. Now, this issue of commercial papers to meet the short-term requirements, this we call it as bridge financing, and it is usually done to meet the short-term costs of the short-term expenditures of the company. Now, the third type of money market instrument is the call money. Now, what is call money? Call money is a short-term finance repayable on demand with a maturity period of 1 day to 15 days. So, they have a maturity period of 1 day to 15 days. So, it is used for interbank transactions. Now, commercial banks have to maintain a minimum balance known as the cash reserve ratio, that is the CRR, and call money is a method by which the banks borrow from each other to be able to maintain the cash reserve ratio. Now, we should understand what is the meaning of the word call money. So, call money is a short-term finance repayable on demand with a maturity period of 1 to 15 days. So, this call money is for a very short period, that is from 1 day to 15 days. This call money will be a source of finance. Now, this call money is usually a source of finance for the commercial banks. Now, as we all know, all the commercial banks have to follow the rules and regulations laid down by the RBI, and as per the RBI rules, every commercial bank has to maintain the CRR. Now, what is the meaning of CRR? CRR means the cash reserve ratio. So, they have to maintain this cash reserve in their banks. So, whenever the banks don't have sufficient funds, they borrow from each other for a period of 1 day or for a maximum period of 15 days. So, they borrow from each other to maintain this cash reserve ratio. Now, we should understand that whenever the banks borrow from each other, they have to pay an interest called as the call rate. Now, this call rate keeps on varying. It keeps on varying from day to day and hour to hour. So, if there is a very high call rate, then all other rates or all other interest rates will become cheaper. So, we should understand that there is an inverse relationship existing between the call rate and other rates of interest. So, whenever banks they borrow from each other, they have to pay an interest called as the call rate interest. Then, the interest rate paid on the call money loans is known as the call rate. It is highly volatile rate that varies from day to day and even sometimes from hour to hour. There is an inverse relationship between call rates and other short-term money market instruments such as certificates of deposit and commercial paper. So, where we should understand that there is an inverse relationship between call rates and short-term money market instruments. Now, there are other money market instruments like certificates of deposit and commercial papers. So, if the call rate is high, the interest rate on this will be low, and if the call rate is low, the interest rates on the certificates of deposit and commercial papers will be high. Now, the next type of money market instrument is the certificate of deposit. Now, we should understand the meaning of the word certificate of deposit. Now, the certificates of deposit are unsecured, negotiable, short-term instruments in bearer form issued by commercial banks and development financial institutions. So, they are short-term instruments in bearer form. Bearer form means it is easily transferable. So, if I just hand over the certificate of deposit to some other person, it will be his. It is just like a currency note which is easily transferable. So, whoever is having that money, he will be the bearer of that money. So, in the same way, a certificate of deposit is issued as a short-term instrument in a bearer form, and it is issued by whom? It is issued by commercial banks and development financial institutions. So, if you are having a fixed deposit, so if you have 5 lakhs of rupees and you want to put it in a fixed deposit, so you can always keep it in the fixed deposit in commercial banks, and then the bank will issue a certificate of deposit stating that such and such a person has deposited this amount of money for a period of 1 year or 2 years or 3 years. So, depending on the depositor's interest. Now, they can be issued to individuals. So, they are issued to individuals, corporations and companies during periods of tight liquidity when deposit growth of banks is slow but the demand for credit is high. Now, these certificates of deposits, they are issued to individuals, corporations and companies. So, when they issue this? It is issued during periods of tight liquidity when the deposit growth of banks is slow. So, when the banks are having a very low deposits, then they can issue this certificate of deposit. And when the demand for credit is high, when the deposits are low but there is a very high demand for the loans from the banks, then banks will issue this certificates of deposit to finance the large corporate houses. Then the next type of the money market bill is the commercial bill. Now, what is a commercial bill? A commercial bill is a bill of exchange used to finance the working capital requirements of a business firm. It is a short-term, negotiable, self-liquidating instrument which is used to finance the credit sale of firms. When goods are sold on credit, the buyer becomes liable to make payment on a specific date in future. So, when a trade bill is accepted by a commercial bank, it is known as the commercial bill. Now, let us understand what is the meaning of the word commercial bill. So, it is a bill of exchange used to finance working capital requirements of the business firms, or this is a short-term liability, or we can also call it as a current liability. Now, it is a short-term, negotiable, self-liquidating instrument which is used to finance the credit sales of firms. Now, what do we mean by credit sales of firms? Whenever the firms sell goods on credit, there will be a large number of debtors. Now, these debtors will be giving us the various bills of exchange, or the company will draw the bills receivable on these debtors, who will be obliged to pay these bills receivable at the end of the period mentioned in the bill. Now, these companies, they have to wait for a very long period when this bill will be paid by the debtors. So, when the company is in need of urgent funds, it can always take these bills receivable, go to the bank and get it discounted with the banks. That is, they just give the surrender the bill to the bank, and the bank will give them immediate payment after deducting a small amount of interest on those bills. Now, when the banks, they just exchange these bills for money, we call these bills as the commercial bills. Now, these commercial bills are used whenever there is a credit sales in the organization. So, in order to finance the credit sales, we have this facility of the commercial bills, and they are also where for a very short period, that is, it will be anywhere between 3 to 6 months within which this bills have to be liquidated. So, these commercial bills help the working capital requirement of the companies. So, whenever there are sales, credit sales which are done and the company is finding cash crunch, then it can usually raise the short-term loans with the help of these trade bills, which will be later on called as the commercial bills. I hope you have all understood the various kinds of money market instruments which are being traded here, and also the different types of markets which are present in the financial market. Hope you have all understood. Thank you.